right, everybody. Welcome to Magnolia on Your Money. This is our first video that we're putting out from our new studio in-house here in the office. So we're really excited. It's really cool that we're able to do this. Back in COVID, we came up with the idea. Brooke has worked really hard and put together an awesome studio. I'll give you guys kind of a shot here so you can see how it is. We got a little bit more to do, put some stuff on the walls here. But we have all the tools. We can interview people from around our local economy and also other places. But it'll be a quick way for me to get in here when something's happening and shoot the information out to y'all. So we're excited about better communication with our clients. And then also I'll be doing quarterly kind of an economic report on what we see coming over the next quarter. So with that, let's go ahead and get started. Oh, quick disclosure. This is not buy or sell recommendations. This is just some economic data that we look at personally here in office. But this is not a recommendation to buy or sell any stock, bond, mutual fund, or any kind of investment. So, and at the end, I'll have some disclosures and you can stop the video and look at those. All right. First slide, we have our economic and financial indicators. You've seen these before. We've put them in the newsletters in the past. And we think it's just a great way to take a snapshot of the pulse of the economy. So just to let you know, green is a positive outlook, and this is 6 to 9 months looking forward. Yellow is neutral, not good or bad, just neutral. And then red would indicate a negative 6 to 9 month forward-looking outlook. So right now we have 17 greens positive. We have 3 that are neutral and no negative. But from what we see from indicators, this really points towards a good end of 2021 and good growth through hopefully most of 2020 and possibly further out. So that's good news. And these indicators range. You can look at all the topics here, but monetary policy, energy cost, consumer spending. So it goes over a good bit of what's really going on and what are the numbers showing us. This slide is really interesting. It shows that it shows our GDP. And let me come over here. I can say so. GDP first quarter grew at 6.3. Quarter 2 was 6.6, and then Q3 numbers have not come out yet as of this video. So we're looking at somewhere in that range there. We'll see how that ends up. And then quarter 4. So last year we ended the year negative in GDP. Of course, the pandemic pulled that down. But this year we should end somewhere in between 5.25 and 6. We're ahead of that mark right now. We'll see how it ends. And then going into 2022, still having decent GDP growth. Anything in the 3s and 4s is good. So that's good. That looking forward looks really good for us. And then down here is a chart of corporate profit growth, consumer price index, federal funds rate. So everything into 2022 looks still good with profit growth and Fed funds rate staying low. So all of that is good news. I've had a lot of questions of Ed, where are we now compared to where we were before the pandemic? So this graph shows that. So that little dotted line is showing pre-pandemic peak levels of each of these, different sectors here. But, across the board, we are either at that, pretty close to being at that pre-pandemic or already surpassed that. So, looks really good. The labor market is one of the major parts that continues to lag. So that's getting worked out and things are moving ahead pretty good. Inflation. If there's anything that I've heard more about over the last year, it is inflation. And how's inflation going to affect us? Well, I'll say right off the bat, most of the inflation that we are seeing is transitory. So when you have supply chain issues, when you have more people wanting a product than they can supply, then that pushes prices up. Okay, so once supply chain issues are resolved, which they're taking longer to be resolved than we hoped, but once that's resolved, then that inflation pressure should come back down. And that's what they call transitory. It should leave us. One of the things to be aware of, though, is our wage growth. So we've had major wage growth, which ends up coming down and affecting prices of goods. Business owners are going to pass that cost of workers' wage down to the end product or the consumer, which is us. So that could keep inflation pushed up a little bit, but we'll wait to see how that affects us. But it is something we watch out for. The other big topic is the Federal Reserve tapering. So the slowing of their security purchases, bond purchases, and Chairman Powell came out and indicated that by mid next year, they hope to be done with their buying. So if that happens, a lot of people are worried about the market's return and that the market's been kind of kept up or pushed up by these purchases. But when we look at history, back when Bernanke did this in 2013, there was a pullback when he first mentioned it, 5.6%, but then we had an 18.8% rebound in the market. And then when actually he started tapering and we had the taper in December of 2013, we did have a pullback, but then another rebound. So we've seen in the past where it's very short-lived, any kind of market downpull. Market outlook, once again, still looks good across the board. You can see equities are pretty strong, forecasted returns. The one part there in the middle is the bond portion, which has our attention. Anytime you're in a interest rate environment like we are currently, bonds are a big concern moving forward if rates start to move up. So we're watching that. We're adjusting portfolios to hopefully be in a good position for that. But overall, a balanced portfolio, 60% stocks, 40% bonds, looks like a expected return between 6 and 8%. And so if that happens, that's great, good, solid growth. So some of the factors that are going to impact our equity returns, we have tailwinds, which I think currently tailwinds are outweighing our headwinds, but you can see here, upwards earning trajectory continues, fiscal stimulus, supportive monetary policy, and there's a lot of confidence in our outlook. Headwinds, we do have stock prices that are on the higher side, rising interest rates, and you always have tax increase potential. That would hurt us. But we'll see how all this shapes out. But right now, our tailwinds are giving us more of a has more weight right now than the headwind. I think this is our last slide, but J.P. Morgan puts this out, and there's a couple other companies that put out the same type information. But this is a good, reminder that intra-year declines are normal. So despite average intra-year drop of 14.3%, annual returns were positive 31 out of 41 years. So this is just going back to 1980. So even if you start and you look at 1980, we had a negative 17% drawdown at some point during the year, but we ended the year up 26, similar to last year, where we had a drawdown of 34% from the high of the market there in February. And then I think by the end of March, somewhere in February, about mid-March, we were down 34%. But we ended the year up 16. So once again, it's just a good graph to look at and remind us that, we do have fluctuations in the market, but we can't overreact. That's why we put financial plans in place. That's why we're always, very cautious about, making sure our investment risks are in place, and then just sticking to the plan. Once you create a plan, you stick to the plan. Not that you can't adjust, but mid-year fluctuations do happen. And so this is a great graph for that. Well, I hope this helped. Here is the disclosure information. You can stop your screen, take a look at these. Just talks about the slides. But main thing is, I'm going to keep pushing this out on a quarterly basis, our quarterly reports. And then also as things happen in the economy that we need to get out, we're going to be able to jump in here on a new studio and do that. So I appreciate y'all listen. Feel free to pass it on to anybody that you think would benefit this. And once again, if you see Brooke in the office, thank her for all her hard work to get this studio going. And y'all have a great weekend, and God bless.